Thank you very much. Thank you, everyone, for attending this session. I know that there are many competing sessions. Thank you for choosing this one. I hope I won't, you make the right decision. So firstly, I want to acknowledge, this. It's my privilege to present today with Yumo. Yumo is a PhD candidate from ANU, and he's very talented, did lots of hard work, and come up with brilliant ideas. So first, I want to acknowledge, Yumo's great contribution to this work, and this is part of his PhD thesis. Yumo is also currently on the job market, so if you're interested, please feel free to reach out. And also, I want to acknowledge our co-authors. Jed Fries is a very famous professor from University of Wisconsin Madison and also ANU. And also, we have Dr. Francis Hui from ANU as well. So we three are in the Yumo supervisory panel. And also, I want to say that if you are interested in this work, you can find our full paper freely available online. You just search this title, and this has already been published in the ASTIN Bulletin, but we made open source article online through SSR available. And if you're interested in implementing this model, please feel free to reach out to us. We are a group of academics, but we have pure interest working with industry. So we hope to understand your pain points. We want to work with you. Okay, before I start this session, I want to ask you a question. So managing customer relationship, I believe, is a core component of your business, right? So which one do you think is more important, customer acquisition or customer retention? Anyone want to share some insights with me? Retention? I heard lots of retention. So anyone want to tell me why retention is more important? Multi-year cost. So yeah. So retaining a customer is much cheaper than trying to get a new customer. So this is exactly the figures that we found when we do this research. So maintaining a good customer is very important for the business. This is one of the motivations for this, for the project. So just for those of you, I'm sure that most of us are already familiar with what is customer churn, but just for those who are not super familiar, customer churn has lots of other names: customer attrition, dropout, turnover, or defection. It basically refers to a customer that's already in your, it has a relationship with you, they sign a contract with you, but they chose not to renew and just leave the company, right? So, and in the industry, it's actually managing customer churn is a very important problem. The reason is that, so especially for general insurance, the contracts are renewed periodically, right, annually, basically. And from the figure that we found online, for example, about 19% of Australian small business owners switch commercial insurance providers every year. And this is a figure a few years ago. And I'm sure that, similar things could happen for personal lines or for life insurance. So we take the commercial line general insurance as an example, but I'm sure that this type of modeling could be applied to other lines of business. And why managing customer churn is very important. So as what the audience just mentioned, keeping a current customer rather than acquiring a new one is much cheaper. It's more profitable. Secondly, so long-term customers typically take up less of the company's resources compared to new customers. And also, customer churn analysis is related to the insurance pricing process. So for example, if I build a customer churn model, it actually can be used by two departments of the company. The first one is a marketing department. They can use this model to identify those customers who are most valuable. So later on, Yumo will show how can we use lifetime value to measure a customer's value to your company. Secondly, this can be regarded as a demand modeling. So of course, it's subject to the jurisdiction's regulation. If you're allowed to use demand modeling to model the customer's behavior, then this can be used for your pricing process to optimize the prices. So it can be used by both marketing and pricing team. And also customer churn, whether a customer would like to stay in your company actually represent the company's reputation. So, we want to have high customer loyalties for your business. And okay, so what's the current, industry practice? According to the best of our knowledge, currently customer churn analysis mainly focuses on building a static model. So we basically model the customer, we throw the data into your maybe a logistic regression model, and then you can come up with a probability whether this customer is likely to churn or not churn, right? So it's basically a static model, one period, and you are only modeling one state transition, that is whether they will leave or they will stay. So here is a summary. You can use potential binary logistic regression model, or if you're a fan of machine learning models, you can definitely try random forest, gradient boosting, or support vector machines. So later on in this work, we also try some machine learning models or even neural networks. So, but no matter how fancy the model is, you are essentially solving the same problem. That is, just look at what's the probability of the customer leaving the company. Okay. So what we want, tell you is that the real industry business is actually more than that state transition. So firstly, currently there are lots of insurance products innovations, and usually for like a commercial insurer, you could have multiple coverages for a single policyholder, or you can have multiple contracts for a single policyholder. So the real business relationship is not just the one coverage, but the customer could transit from, say, they maybe purchase the auto insurance first, and then they add on home insurance, maybe they drop home insurance, and they add on something else, and maybe 3 years later, they leave the company. So the real relationship with customers are more than just a one coverage, leave or not leave, but it's like a multi-coverage relationship. And secondly, it could also be like multiple contracts. Secondly, the real relationship is multi-year. So you actually are looking, although your contract may be just 1 year, but the relationship with the customer is multi-year. Like they could renew for 3 years. Maybe in the first year, they add one coverage. In the second year, they drop one coverage. In the third year, they leave the company. So you're actually managing a multi-year relationship. How can we take this multi-coverage and multi-year and multi-state transitions into one model? So now I want to pass on to Yumo to give you an example.
Hello, everyone. Thanks, Fei, for the great introduction. I find it's interesting to talk about customer churn with you today because, on the one hand, we are all customers. So personally, I have car insurance. I have life insurance. And on the other hand, we all work in the insurance industry, so we know how insurance works, and we know the importance of customer churn. So Fei just mentioned we developed the idea of multi-state customer churn. So let me give you an example. So let's say now I start a new business. I own a company. And in the first year, I buy a building insurance for my company. Then, here. So in the second year, I try to be a good boss. So I buy car insurance for my employees. However, in the third year, I find that there is a cheaper car insurance products in the market. So I cancel the car insurance from this insurer, and I buy a car insurance from someone else. So as you can see now, for this insurance company, I only hold the building insurance. And then, finally, maybe I'm not a good boss, so I go bankrupt. So I cancel all my insurance coverages. So in this case, we can see that we actually have 3 states. The first state is in year 1, we have building insurance, and then we go to state 2, building insurance, car insurance. So in the third year, we go back to state 1, so it's building insurance, and in the fourth year, we go to state 3. So this is a transitions among 3 states in 4 years. So this is a very simple example of the idea of multi-state transitions. But I guess you have better ideas of multi-state transitions than me because you all work in different insurance companies, so you know there are a lot of different insurance products, and your customers may decide to buy different insurance products year by year. So you can think about how your customers transition between different states. So we will show you a real application. So we study the data from Wisconsin Local Government Property Insurance Fund. We call it LGPF. So it's a very special commercial insurance. The policyholders, they are not people. They are government units, such as schools and hospitals. So there are 3 types of coverages in this commercial insurance. We have building and content, we call it BC, and we have equipment coverage, we call it IM, and we have vehicle insurance, we call it car. So in this case, building and content is compulsory. So that means if you want to buy insurance, you must buy the building and content. And the other 2 are voluntary. So in this case, due to the feature of data, we developed a 3 states diagram. As you can see here, we have state 1 to be called full coverage. That means the policyholders take building insurance, equipment insurance, and car insurance. And state 2 is, we call it partial coverage. That means the policyholder at least have the building insurance, but they don't have the full coverage. And state 3 is churn. So we have this 3 states diagram, and we need to build a model, multi-state model, to model all these transitions. As you can see, we have 4 types of transitions here: full coverage to partial coverage go back to full coverage, and both states goes to churn. So there are 4 types of transitions. So we need to build a multi-state model, but this problem, you can treat this problem as a dynamic multi-class classification problem, because in each year, conditional on the current state, the policyholders can move to 3 different states. They can either move to full coverage, partial coverage, or churn. So this is like a dynamic multi-class classification problem. And so it's not a new problem. So we have different multi-state models available. In this paper, we use multinomial logistic regression. So it's a multi-class version of binary logistic regression. However, if you like machine learning models, you can also use tree-based models like a gradient boosting machine or support vector machine or the neural networks. But in this paper, we don't apply the neural network. We only build a GBM and SVM for comparison purposes. And before I show you the model, we need to discuss a technical concept called the order of the model. So order only exists for multi-state models. And to make it not technical, just let me tell you a very simple example. So the order means how many previous states do you assume affect customers' current state. So for example, if you assume the order is 1, that means we assume the current state is only affected by the last state. This is like a constraint on human memory. You assume first state, that means you assume customers' current decision is only affected by their last decision. It's like I bought a car insurance last year, so I decided to buy a car insurance this year. So this is first order assumption. And the second order assumption is we assume the current state of a customer is affected by 2 previous states. So that means the state at t minus 2 and the state at t minus 1. So if you look at the existing models, like binary classification models or the multi-class classification models, you will see that most of models apply the first, it's called first Markov assumption. And, but in this project, we actually apply a second order assumption. And the reason is we investigate the data, the Wisconsin data. So you can see from table 1, this is the empirical transition counts and the empirical transition probabilities. And the reason we decide to use the second order is that you can compare the second row and the third row. So the second row represents the policyholders who had full coverage and full coverage in the last 2 years. The third row means the policyholders had partial coverage and then full coverage in the last 2 years. And you can compare their empirical probability of churn. So for the full coverage policyholders, their churn rate is 2.93%, but for the partial and full policyholders, their churn rate is 0. So when the policyholder moves from partial to full, that means this policyholder add some coverage. They either add the equipment coverage or car coverage to their bundled insurance contract. So which is a good signal. You know that when you observe your customers purchase more, that means a higher, or say a better customer loyalty. So when you observe this good customer loyalty, they have 0 churn rate. So they never churn in this data set. However, they have the same state last year. So that means they have same first order, but they have different second order. So they have different like purchasing behaviors. We also observe the same story when we compare the last 2 rows, the full partial and the partial partial. So if you compare these 2 groups of policyholders, you see their churn rates are different. So for the full partial, that means these policyholders cancel some coverage. Or say it's a bad signal for the insurers because your customers like decide to purchase less insurance products from your insurance company. So it's a bad signal. For the partial, that means these policyholders still stay in the partial. And when you see the bad signal, you will observe a higher churn rate. It's like the churn rate is double. You can see it's 6.6. And for the partial, the churn rate is 3%. So this is the reason why we decide to use a second order instead of the first order assumption. For those who are interested in the modeling detail, so here is the first order model and the second order model. As you can see, when you assume different orders, you will have different modeling structures. And theoretically speaking, the second order model is more complicated than the first order model. But I don't want to go to the technical details, so let's see the result. We don't show you the parameter estimation result today because it's a table of numbers which is not interesting. So I want to show you the first is managerial implication. It's called visualizing the effect of explanatory variables. So we have 2 plots here. On the left-hand side, it's called conditional effect plot. On the right-hand side, it's called marginal effect plot. So conditional effect is for a specific policyholder. Marginal effect is for all the policyholders. So in machine learning, people will call the conditional effect plot the partial dependence plot. So they are the same thing. We investigate how one variable affects the transition's probabilities, conditional on fixing all the other variables at fixed values. So the vertical axis means the transition probabilities. The horizontal axis is called ratio premium. So that is a ratio of this year's premium over the last year's premium minus 1. So if it is 0, that means the premium doesn't change for 2 years. If it's positive, that means the premium for the policyholder increase. If it's negative, that means premium decrease. And this is like the sensitivity analysis when you want to decide the final price of an insurance product. Because when we decide the final price of an insurance product, we don't want it to be too high because if the premium is too high, it leads to the customer churn. I know, we all know this. But we don't want it to be too low. If it's too low, that means low profit. So when you build a multi-state models, you can show this kind of plots to decide what kind of price you want to set for the insurance product. And you can see the customer's reaction to different prices. So if you look at, let me see, the red curve, that is a probability of churn. So if you have higher price, then the customer will have higher price to churn. And also the transition probabilities among different states will also be different, conditional on different price. The second manageable application is more interesting. It's about customer lifetime value. So if you are interested in customer management in marketing science, you will see that recent studies have shown that customer lifetime value is like more important than customer churn, because researchers show that it's a better strategy for companies to focus on the customers with higher lifetime value instead of the customers with higher churn risks. So from this perspective, when we build a customer churn model, at the end of the day, we need to use this model to calculate the lifetime value of customers. So in this slide, we compare the traditional customer churn model versus the multi-state customer churn model, and I will show you how to use these two different models to calculate the customer lifetime value. So on the left-hand side, this is a traditional customer churn analysis model. The traditional way only focuses on two outcomes. It's renew or churn. So currently, the customer have the full coverage. They have building insurance, car insurance, and equipment insurance. And 1 year later, if you do the traditional analysis, the customer will either renew or churn. And 2 years later, they will just renew or churn. So in 2 years, there will be 3 scenarios. It's full renew, churn, or churn directly. So when you do the multi-state analysis, because we define the multi-state, so that means we can model all the possible future scenarios. So in 2 years, when you do the multi-state analysis, you can have 7 scenarios. And based on these different scenarios, what we can do is we quantitatively calculate the value of customers and calculate their lifetime value. I want to let you know that we will only show you 2 years. That doesn't mean the customer lifetime value is about 2 years. It's about many, many years. You can use 20 years or 30 years or infinite years to calculate the lifetime value. We just want to make it simple. So that's why we show you only 2 years. So for 2 years, the value of customer is actually calculated by the revenue of customers, the expense of customers, and also the transition probabilities and discount rate. So if you are interested in those numbers, you can just review the paper. But finally, we get the lifetime value of this customer using the traditional way. It's $2,917. And we do the same thing using the multi-state customer churn model. We consider 7 scenarios. The final lifetime value is $2,844.5. The difference is $72.9. So why we have the difference? As you can see that we have different scenarios, and more importantly, we find that when the customers are in different state, they have different values to the insurers. For example, in this data set, we find when the customers are in the full state, they have higher values to the insurers compared to the customers who are in partial state. So you may know this better than me because you work in the insurance company. You know that some contracts, they are more profitable. Some contracts are not. So when the customer buys a profitable contract, they actually have higher values compared to the contracts with lower values. So that means when customers have different choices, they have different values. So it's important to consider all the possible scenarios of the customers so that you can accurately calculate the customer lifetime value. So this is why we do the multi-state analysis instead of the traditional customer churn analysis. And also, for those who are interested in the prediction, we also do the out-of-sample predictive performance. This is a multi-class classification problem, so we evaluate our model using the macro AUC, macro AUC, binary AUC, and top decile lift. And we find that our model, the second-order multinomial logistic regression, has consistently strong out-of-sample predictive performance compared to several parametric models and machine learning models like support vector machine and gradient boosting machine. Okay, thank you. So that's all. Thank you.